Imagine you've spent years building your practice. You finally have some real cash flow in your corporation. Hundreds of thousands are sitting in your corporate account, but you're afraid to invest it because you don't want to lose it, or you don't want to lose the liquidity. And your accountant keeps reminding you that there are passive income taxes, which are taking half of any of that interest that you're using or earning inside your corporate account. Today, we're going to be digging into a real client story, a medical professional from Calgary who found himself sitting on over $700,000 of retained earnings that he didn't know what to do with. So we're going to dig in here. We're going to chat about some of the things you could do. Yeah. We'll talk about the rational things you could do, like, for example, take it all and invest it in the long term and everything will be fine. But the reality is we're also going to address the behavioral piece, which is emotional, the parts that hold us back from doing things we know are good over the long term due to short and medium term fears of illiquidity, cash flow crunches, or maybe just having a business slowdown. So, John, this inspired me, this conversation with this individual. First of all, they're doing great things. They're not spending a whole lot. We're going to call him Mark, and Mark today is going to be from Calgary. So two things that we are changing. And for those, it's funny when we hop on a call, people say, are you going to talk about me on the podcast? And I always like to reassure that we always change. Yeah, we're going to talk about you. I promise. We're going to talk about you, but we change names, we change locations, we even change professions so that it is very almost impossible to identify. But today we're going to dig into this one. So for Mark, first thing I want to say, like on this call, they're doing the right things. They're not overspending. They're paying themselves an appropriate amount. They're not overpaying themselves and paying more tax than they need to. They're not underpaying themselves and leaving too much of those low tax bracket years on the table. That's sometimes what we find when we're working with incorporated business owners. But there's a challenge here because those retained earnings, they know they don't want to pull them out, but when they sit in there and they only sit doing a whole lot of nothing, that's obviously not a good move. It's almost like analysis paralysis takes over, right? And the longer we sit, the longer we wait, the less those dollars are worth. So today we're going to talk a little bit about what we could do, some of the options, and then what we see many of the business owner clients were doing, sort of working towards and shifting towards so that they can kind of get the best of all worlds.
Yeah. And this being a Friday secret sauce episode, we will end it with his health assessment, on not his health assessment, his financial health assessment on the 4 stages, and we'll give him a grade. So stick around to see, and hear about specifically that assessment and where you can also learn about your assessment. But, when you mentioned that, and this is a common kind of pebble that I think, and I think business owners might not see it as a pebble, because you said that he's holding a significant portion of his retained earnings in, say, cash on the sidelines. And if you look at our assessment, if you look at the 4 stages of what we would say is a healthy assessment, the second component is about a wealth reservoir. And so we've used the term emergency fund. We've used the term like, this is your opportunity fund. So immediately you might, if you just heard those terms, you might be like, well, I should put some money on the sidelines. I should have cash sitting over in those sidelines because that's my emergency fund. That's my investment fund. This is when the market dips, this is where I pull from. And, this is my the wedge when I need a wedge. So it makes sense to have that corporate fund. And while we would agree that that's an important component, the structure, the container that fund is sitting in could be optimized a little, especially in Mark's case here. And I think what we're going to kind of unpack specifically when we start to get into the numbers for Mark and his scenario is give him some recommendations that could actually keep that liquidity there, but also set him up for some success to help with the other stages of his financial health.
Yeah, absolutely. And, just to kind of frame things a little bit, they've only been incorporated for a couple of years. So in that startup phase, really the hope is I hope that I have money left over after expenses, after paying myself and all of those nuances, which is happening here, which is great. But at the same time, there's also this hesitation, in the early years when they set up a business to go like, can I repeat this? Like, is this going to happen every single time?
Got to keep that over there.
Yeah, I've got to have this like safety net going on. And then comes where should I be doing some of these things? So the first thing we discussed with Mark was really about saying, listen, with those retained earnings and each year, so this past year he had grown about $600,000 of retained earnings. So he's really starting to see the retained earnings grow. And I said, let's use 500,000 as an example here. Okay. If we use 500,000 and if we think that 500,000 is reasonable, and for a lot of people, they want to grow that over time, but let's say it's 500,000 from year to year, we definitely want to make sure that a good chunk of that is being invested. Now, some people would say, well, Kyle and John aren't huge fans of, say, RRSPs. In this case, the more retained earnings you have, the more open I am to taking a little extra to yourself via T4 in order to fund your RRSP, just from a bucket diversification play, right? So we're not saying that, we love the fact that, we're going and taking some dollars from the low security prison we call the corporation and putting it into the high security prison, which is the RRSP. The part I do like is knowing that I have some assets on both sides of that corporate border. So in his case, because he has a significant amount of retained earnings, I would totally be open to, hey, listen, take 10, 20, even up to maybe $30,000. Right now, he's not taking a huge salary as it is. So I wouldn't get too carried away with the RSP because he doesn't need to put himself into a high tax bracket currently. So I would say, you know what, take about the 135. He's taking a little less. Take the 135. You're going to net out about even on a portion of the corporate income tax because he is earning technically over $500,000 in the corp, and fire it into your RSP. Like, that's a great first start. Set it and forget it. I say set it and forget it. Like, put it into those long-term ETFs. I would focus mostly on equities for those types of investments because we're going to hit the fixed income portion utilizing some of our other strategies and tools. However, I wouldn't stop there. I would also consider potentially utilizing the tax-free savings account. Again, you take an extra $7,000 out a year, you're going to pay a little extra tax, but it's only $7,000 compared to $500 or more $1,000 inside the corporation. So again, more diversification, more investments happening. But we don't want to stop there. Like, more of that chunk should get reinvested inside the corporation into the longer term assets, whether it's real estate, we tend to be, more focused on real estate, or whether it's the markets or whether it's gold or whatever it is that you're into. Like, we're not here to judge that, but we're talking about assets that are volatile. They're going to grow over time. And they are going to grow inside the corporation. Keep in mind, corporate investments aren't going to be completely sheltered from taxes. But as long as we focus on capital gain assets, we can at least kick that can further down the road. We still get a tax credit on half of the upside, which is great, through the capital dividend account. And you should be investing over there as well. So first and foremost, that was sort of our recommendation is you've got to decide how much of that bucket do you feel comfortable and confident to take, earmark, and put into those longer term investments, because that's going to be a good play. But the challenge then becomes is, what is that number? What's going to make you feel comfortable? And how much quote unquote liquidity do you feel you need? Whether it's rational or just emotional or a little bit of both, that's the part where the real strategizing comes into play here.
Yeah. And what you're talking about the buckets and choosing and making sure that you're taking 135 and it makes sense in this case, like that in our world, that fits into that third category, which is like our optimization structures. Like, what are the tools and the buckets that we have access to? And are we strategically deciding on when and why that bucket makes sense? So before we kind of keep moving here, because I do want to kind of think about specifically big picture here for Mark in terms of what he thinks is in that say zone is like, where should I start pulling more money to put here or in personally or inside my corporation, and making sure that I'm trying to grow and have a great growth structure, but also a great safety structure. You did mention, say, that idea. I think that we kind of skipped, not to say skipped, we kind of like fast tracked through the RSP move there. Like hey, it makes sense to pull from the RSP. You mentioned 135, but then you also mentioned he's making more at, in the corporation at 26 over 500,000, so he's paying a little higher on that section of his retained earnings. So, but I think it's like maybe just touch to the listener right now on going like, hey, wait a minute, why bump it from 100? Like, yeah, I can take the $30,000 difference between my 100 I'm taking now to all of a sudden make it 135. And is that because all of a sudden now it's all in the tax free? And then why tax wise does that make sense before we go on to say this bigger strategy for Mark?
Yeah, absolutely. And I'm glad you did kind of like, pump the brakes on that a little bit, because we don't want to gloss over it.
No, it's a good move.
When your company starts earning, or your corporate, we'll call it any of your connected companies, earn over $500,000 of net operating income. So this is after expenses, not a gross number. It's not, hey, we brought in 500 and then we had 200 in expenses and then we have 300 in net operating income. We're saying if that net operating income number goes above $500,000 across the board, all across all of the provinces and territories, you're going to pay a higher income tax rate on those dollars inside the corporation. So whether you're in Ontario like us, paying 12.2% on the first chunk, that next chunk is 26.5%. He's in Alberta, so he's going to pay a little less than the 12.2 on the first chunk, and then he's going to pay a little less than the 26.5% on the bigger chunk as well. So the logic here is that at a personal level, if I'm paying 26.5% on any dollars that are in the company from year to year, those dollars at the corporate level, I should be considering what my tax rate, my average tax rate, not my marginal tax rate, my average tax rate is, so that I'm at least at the 26.5% mark for us here in Ontario. For Mark in Alberta, you find that number, right? And we can help people with doing that. And we do this all the time to go, you know what, if I'm going to pay the tax anyway, why pay the tax and let it sit in the company when I could go ahead and just take it now, pay the same amount of tax?
And that's why.
And we're going to get more RSP room. In this case, Mark's taking only about $100,000 per year. And I would argue that's great if you're earning less than $500,000 in net operating income in the company. I would say, yeah, take less. And I wouldn't even, really go too gung-ho on the RSP yet, because $100,000 isn't like putting you into a huge tax bracket. But now that he's got some chunk of cash, it's around $600,000. That extra $100,000 or so is paying 26.5%. And that's going to put him somewhere around the $130,000 or $135,000 mark at a personal level in order to match that. Now, again, I'm speaking Ontario numbers, but this is very translatable to other provinces as well. So I would say to him, you know what, you take the extra 30, the extra 35, whatever it is, you pay the same amount of tax on it anyway, and you immediately take that chunk and we're going to fire it into the RRSP. As long as you've got room, you can.
Because you're not going to pay tax on it now. You'll pay tax on it later.
Exactly.
But you already paid your 26-ish, and now you've, say, paid it to yourself, but then since you're immediately putting in your RSP, you're not personally paying tax on it. You already paid your 26-ish%, and now you're just going to grow it on your personal side.
Exactly. And I mean, the beauty is if you took it, let's pretend we're right at the dollar for dollar. If you take it as salary, not as a dividend, but if we take it as a salary, we're going to not only get the RSP room,
right?
But those dollars that we take out weren't taxed in the corporation. They're going to get taxed at a personal level. But because I put it in the RSP, it's not taxed at a personal level. So those dollars are 100 cents per every dollar that gets to get invested inside your RSP. Now, remember, we have to remember that we get taxed on the entire withdrawal amount coming out. So there's no 50% capital gains that, are exempted from the tax. Like none of that's happening, but you get 100% tax deferred growth, which is a huge win, right? So for incorporated businesses, we really have to be thinking about what I'm earning in the corporation, what are the taxes that I'm going to pay in the corporation, and is there an opportunity whenever there's a chance to rescue more dollars out of any of our taxable buckets, right? Whether it's tax deferred in the corporation or in any other bucket. Unfortunately, there's no way to ever rescue dollars out of an RSP. It is going to get taxed on the way out, whether it's you or whether it's your estate, it's going to get taxed. Whereas in the corporation, we have way more flexibility. But when there's an opportunity to break even or better, we want to take the opportunity. And in that case, he's going to break even, and he's actually going to essentially pay zero tax on those same dollars. Whereas if he takes it and puts it in his pants pocket or in
Makes
his
sense.
corporation's pants pocket, he's going to pay that tax. And it just doesn't make sense in that particular case. So that's a huge move that, again, comparative, like this is the tough part though. You compare, let's say, he takes 135 and it opens up around $20,000 of RSP room every year when he does that. He can utilize that $20,000. That's not going to be the game changer though, because 20,000 compared to 500 or $600,000 of retained earnings, you can see very quickly that, this number is a very small chunk of that number. So we've got to really focus on this number over here to make sure that we're going to maximize and optimize for those dollars, because these dollars are taken care of, but it's not an unlimited bucket. And therefore, we can't just put all of our eggs into that basket and sort of think, yep, I'm good. We want to make sure that we grow and essentially maximize the opportunity for the dollars that are going to at least be temporarily trapped inside the corporate structure.
Right. And that's what we want to kind of like strategize here for Mark, because it is still in this phase 3 land of trying to optimize your buckets. And one of the strategies that we are going to be trying to like do for every one of our clients is to go, how do I grow that bucket? How do I, if I have money sitting in that phase, or if I'm thinking about the phase, which is an optimization stage, and I've got, say, funds, retained earnings in the corporation, how do I make a good choice between how much should be in my emergency fund over there for business expenses and structure, and the structures around that, and then how much should I be still growing? Because I know that this is a deferral method of my income, is if I'm solely owning this corporation. How do I grow that to create that flywheel effect so that I've got same income, making income on top of income inside the corporation? So how do I balance that in a way? Because sometimes it's like, well, hey, I'm going to put it all into equities and I'm going to make sure that I have a high growth model over there. Or I might be like, wait a minute, this is my future we're talking about, so I need to have a 60-40 portfolio. So let's talk about some of those strategies and the recommendations for Mark.
Awesome. Now, if we think about T4 employees, for example, just for a moment, the original, the sort of go-to strategy was a balanced portfolio 60-40. Those in the FIRE movement nowadays are recognizing that as long as I don't need to touch the money for a very long time, typically people say 10 years, some even say 20 years. If I don't need to touch the money, going 100% equities in those investments is the better move from a rational perspective. So let's flip over here. And the reason why is just returns, right? Like the returns are going to be higher. The volatility is going to be higher, right? Meaning you're going to be on a bit of a roller coaster there, especially if you're not risk managing or you don't have the means to do so. So that you see that floating around a lot, and it's accurate. It is accurate. You're going to earn more that way if you were like 100% equities instead of 60-40. The 40% for fixed income is there to try to minimize the volatility. Unfortunately, only during good times, because black swan events, everything's going to drop regardless. But it also drags down your overall growth of the portfolio. Okay. Now, I'm going to throw real estate into the equity bucket as well, because equities, real estate, they're sometimes volatile. Sometimes there's, we'll say, higher risk, right? With real estate, there's cash flow issues. There's, CapEx expenses. There's all these things. With equities, you don't have that same requirement, but you do have the volatility. So they're both fairly illiquid, meaning if I'm putting $1 over there, I can't expect to get that dollar back next week, even next year, sometimes not even next 5 years. It might have to be even longer. Those in the Vancouver and Toronto markets and the condo market are experiencing that now. Is like, hey, I'm going to have to wait this out because the value of my properties has dropped drastically from when they had purchased it 5, sometimes 6, even 7 years ago. So these are things that we have to consider. When we go inside the corporate structure, what we see is, again, rationally, if you took every dollar of retained earnings that you had and you invested them in a long-term growth asset like the S&P 500, like global equities, like real estate, like whatever it is, pick your poison. If you did that, you're going to have great growth numbers. Now, you're still going to have some tax challenge, right? You still have retained earnings that got to get taxed on the way out. And you have these other things that are going to be there. But the growth of your assets may supersede what those taxes even are. So maybe it's not a concern for you. The challenge we run into, though, is the reality of two things. One is, how much liquidity do I actually need to run my business? Now, if I'm a manufacturer, right, that's going to be probably a large number. But even for those who are like consultants, those who are in low, high margin, low expense sort of industries, oftentimes people want to have more cash on hand than they're willing to put into the markets. Why? Well, if expenses are high, that could be a challenge. What if invoices don't come in? What if I have a slow period? So the reality is that we've never actually run into a business owner. We've been on hundreds and hundreds, I'm going to argue thousands of calls now with Canadian wealth secret owners around the country. And zero of them are taking every retained earning dollar and putting them into long-term growth assets because of this very obvious reason. What we actually see happening is that the vast majority of business owners are keeping a substantial amount in liquid assets, in cash, in other maybe fixed income instruments like maybe GICs, right, in things that are creating passive income taxes. And the reality is that those instruments can do those things very well. They keep the cash liquid, but we don't earn a whole lot on them because we're giving half away to the CRA. Right.
Yeah.
So this is one of the biggest challenges we see for the business owners we work with. And that really opens the door for a massive amount of opportunity that we can dig into.
It's like, if I think I'm putting this into a GIC that earns 6%, I'm really only earning 3% because that growth is going to be passive income, and therefore I'm going to get taxed at 50% inside the corporation. Or if I'm just keeping it in a savings account and I'm earning 4% right now because it's a high, I'm on a high interest savings account, then I'm going to only earn 2%, and then all of a sudden inflation's at 3%, and I'm backwards. Like I'm losing money year to year by keeping the money liquid. So the question, right, is to how do I keep the liquidity, keep control, but still make the dollars work harder?
Right, exactly. And I would say at minimum, what we want to do is we want to figure out like what's that comfort number that, within the next month or two that you realistically need to keep liquid, right? So you're going to have some cash. We can't have $0 in the bank account, right? And I mean, you and I, we optimize all the time. We always have a little more cash than we probably should have, just out of fear, out of, the unknown, all of those things. But when we look at the other side, as retained earnings grow, so this gets, the more we scale, the more profit we have, the more important it is for you to make sure that you're sending enough of those retained earnings into growth assets. You get to pick the asset class. But for the other chunk that's there, and oftentimes what we see happening, first of all, we want to make sure they're true growth, because we have some business owners, they're taking, 40% of their retained earnings and they're sending them into the market, for example. But they're not sending it into a 100% equity portfolio. They're actually sending it into a 60-40 portfolio.
Okay.
That's a big,
happening here.
Huge misstep in my opinion. Those dollars, when you send them off to that long-term account, let's get them into long-term growth assets. That's where we want those to go. Now, go ahead.
Let's just talk about that for a sec. So let's say I take 40%. I've got 60% still in cash because that's my emergency fund, my opportunity fund. Maybe it's in those GICs that we talked about. That maybe you're evening out on return, or you're just not getting a return and going backwards. Okay, so 60% is there because you're going to take the 40%. You're like, look, I'm going to invest 40%. That's a lot. That's a good chunk. But then what you're saying is that what you're seeing is that most people are going, I'm going to do a 60-40 split with that, which means I now have 40% in high growth, and then so therefore I'm like, when we say high growth, you're talking S&P 500. This is like I get 12% over the last 30 years. This is the return I'm thinking. There's 40%. That makes sense. It's going to be a rocky road. Then you're taking your 60% and putting it in more fixed income. We've got bonds. We're talking about other assets that are a little bit lower, which is now in a way mimicking what your other 60% that is left in cash is just doing. So
and
now
I would just flip those numbers around there, John. So it's like, 60, if you send them off, 60% of that chunk, right? This is hard. This is like go back to math class for us, right?
Yeah.
We're taking, percentages of percentages, but basically what you've got is this 40% of your retained earnings are going off to a brokerage account of some type, whether it's self-managed or whether it's managed for you. And what we're seeing is that a good chunk of it, usually around 60%, goes into, say, growth. But the other 40% are going into these fixed income, safe sort of assets. But in reality, like what you were getting at is you already have your safety. Like you already kept 60% of your retained earnings in quote unquote safe things. You kept it in cash, money markets, bonds, GICs, other types of things that are liquid, less volatile. I shouldn't say completely, because if you are going bonds, they're not necessarily going to be non-volatile, but GICs would, right? And then basically what you're getting is you're getting like a super duper fixed income like asset approach. It's almost like you're super conservative, even though that wasn't your initial intent. You meant to send the 40 off and you meant for that 40 to not be touched for a really long time. That 40% ends up getting split up. And basically you end up with essentially like, 25-ish% of the total that's actually
almost
in growth assets.
Calculated it. 76% would stay. 76% of your income would stay in say fixed income assets.
100%.
You're talking 24% is actually, you're saying, hey, I'm putting 40% or 60% in 40% in there. It's like boom. I'm actually only a 24% high net worth investor.
And when we talk to these individuals, these business owners, and we say like, are you like, do you have a high risk tolerance, low risk tolerance? Most people say like, I have a high risk tolerance, but what they're actually showing is they have like a lower actual risk tolerance on, when it comes down to the actual numbers than their great grandma. Like your great grandma has like more risky investments than you do. Now, why? We have to also give respect here to business owners. You already have a lot of chips on the table in your own business. So that is risk on. That's important for us to recognize here, right? Like we don't want people going out there being like, I'm all risk on in my business and I take 100% of retained earnings and I go into more risk, even though rationally, like over the long term, the numbers should work out. But we know that people aren't willing or able to do those things. So what we're saying is, listen, the money that does go off to that brokerage account, we want to make sure that they do go into truly long-term equity-like assets. It's not just equities. It could be real estate. It could be, don't go all in on Bitcoin, especially right now. Well, maybe right now there's a big dip happening, but you get the idea there. We don't want to see that out of that 40% chunk or 50% chunk or whatever you're willing to send off to the long-term investments. We don't want to see those in fixed income. Two reasons why. First of all, you already have too much liquidity in the business itself, in the checking accounts, the GICs, the whatever you're doing over here. But the second reason is that you're actually creating more passive income, right? So you're actually in a corporate account that's going to have dividends or interest, and that is going to get taxed at 50%. So you're kind of like getting hit twice with this passive income issue. So what we actually want to see people do is get those into the right things. For the rest of that money that you are not willing to say goodbye to for a long time because you're either concerned about cash flow crunches, concerned about business, concerned about the unknown, whatever it might be, those are the dollars that we want to now focus our attention to try to solve the retained earnings issue over the long term. Because remember, retained earnings got to get taxed coming out when they touch human hands. So what a perfect opportunity for us to take those dollars and get fixed income like returns without the tax by funding a high early cash value life insurance policy. Now, a lot of people, like every now and again, we'll get people that comment on Spotify or on podcasts that say the answer is always insurance. And the reality is yes, it is, because it is the only option you have to take those dollars that we're going to earn around the same amount on the cash value. You're going to get it without tax, plus have a solution to your retained earnings problem. It honestly is the no-brainer approach so that you can get the win-win-win all around.
Do you remember the one comment where the person said that, and they said like, it's not a great strategy. It's only great for like high income or high net worth individuals who are also business owners. I'm like, who do you think we're talking to?
That's what this show is for. It's for
Right.
exactly those people,
Right.
and we try to be, we try to be, calm about it. And we understand that sometimes, like, we're like, today's episode, I hope people are seeing, is like, if you haven't put $1 into your RSP or tax-free savings and you're a T4 employee, like, do that, please. Like, we're telling you that, but there's tons of other shows to tell you how to Dave Ramsey and how to, get out of debt and save a little bit of money. Like, we're talking about people that want to optimize for these other dollars, and high income T4 employees. If you're earning over $180,000 per year, guess what? You don't get any more RSP room on the dollars above 180,000, 182, I believe it is. So at the end of the day, like, this show is meant for those individuals. So if you're listening right now and going like, this isn't for me, you're 100% right if you're not falling into those categories. So we certainly don't want to see people, we meet with people all the time that they come on the show and, they're expecting us to say like, yeah, get a policy going and so forth. The only time that makes sense, the only time is when maybe an emergency fund at a personal level, you've got 40,000 sitting there and it's sitting in a checking or savings account or something that's accessible. Yes, setting up a policy so that now you're hitting both birds with one stone. So now you're growing your net worth. We don't want to take away from those growth investments. The same's true for our business owners. We want to make sure you're growing and that you've got a nice, good clip going on with those growth assets. But it's for these other dollars that are being underutilized, that are sitting there and essentially inflating away, right? We want to make sure that they're in the right asset, the right tool. And unfortunately, for those who are permanent insurance haters, unfortunately, that's the answer. And until somebody tells me another way to do what it does, I mean, I don't know where the argument is.
Yeah. To make this practical for Mark, like the move that we were recommending to Mark specifically is like, first, come up with like, what is that safety net in terms of like, what's the emergency fund need to be, right? Like, you got to know that number, but in a way you kind of like, the number just so you know how much to earmark inside that component. So let's say every year you have a set of retained earnings, and Mark, I think, what did you say Mark's retained earnings were? It was like,
this last year was about $600,000.
Yeah. So let's say he's got 600,000. So imagine it's like, he's got a strategy I would recommend for Mark is to go like, look, take half of that. If that's going to be repeated retained earnings, take half of that, and then that becomes your premium for your policy. And now every year you're going to put $300,000 into your policy premium. That is going to grow your wealth reservoir. Eventually, that will replace whatever the emergency fund for we use a waterfall method here inside our business. We say, here's exactly what our 2-month, 3-month kind of like emergency to pay all our bills needs to be. And then anytime on top of that, that's now our opportunity fund. So we split, this container into components ourselves. So like when you start funding the premium, eventually you will hit the ceiling on the waterfall, and then any spillover inside that container is now your opportunity fund. So imagine year to year to year, he's continually putting $300,000 into this opportunity fund, which now can do all the things we said. It's now his fixed income asset bucket. It's his growth bucket. It's like, it's going to grow at that 4 to 5%. But it's also liquid enough to borrow against that asset to pay the bills when you need to. It's still your emergency fund. Then the other 50% goes to the equities that are going to be completely growth. And now you've covered the two birds, and you've made it sustainable to do. Now, both of those buckets grow year to year to year because your business is a money-making business. And so all of a sudden now you're just growing that net worth. And both of these things are working in your favor, instead of one losing value every year and the other one being like, well, I could be growing faster, but I didn't. I tried to like balance it.
And John, so like we've just kind of framed out like and we'll call this like the baseline, right? Like this is the conversation you have to have with yourself. You can have it with us, of course. You head over to CanadianWealthSecrets.com/discovery, book a call. We'll go through your situation. But here, most often, John, here's what happens next though. When we propose this as an idea, a solution, they go, but Kyle, I'm planning to buy a building because I'm leasing the building right now. I'm planning to buy the building. And I ask, what's your runway? 5 years, 7 years, whatever it is. And I'm like, ooh, So they're like, so I can't take 50% and put it into those long-term growth assets, right? And I say, you're actually kind of right. You could take a risk and you could take 50%, put it in the long-term assets. But if you need those dollars and 5 years from now, all of a sudden the market's in a big dip and you got to pull money out, that's not going to be a good thing. They want to keep even more than 50% liquid, right? So now I'm going, this is where some business owners do extremely high percentage amounts that are going into a policy because they have plans to buy another business, to buy a building, to do something where they need the liquidity in the next 5-ish to 8-ish years. For example, we had a case study. I can't remember the name we used for the case study, but we had one, a chiropractor who wants to buy the building within a 5 to 10 year period. Well, guess what? That's not a long enough runway to know that the market is going to behave itself when you need the dollars to put it in the building. So they opted for a much higher cash value policy, so a much higher premium policy, so that it can grow, it can be tax-free, but money stays liquid. So yes, they are losing on returns in the shorter term, but it's because they need to maintain that liquidity. We don't want to see that money sitting there while you're waiting to find, the practice that you're looking to buy or the building that you're looking to buy. So there are cases where our 50-50 that you've kind of proposed here today may still not be the right move for you. Now, if you're more aggressive and you're willing to take more of those retained earnings into those longer term assets, amazing, do that. But just don't forget that there is going to be tax to be paid on all retained earnings that you grow throughout your lifetime. And that's one thing that a policy can do. So at minimum, we want to make sure that policy is representing at least the fixed income portion of your quote unquote corporate portfolio. And for most people, at minimum, that should be 30% of the total. But for some, they want it as high as 50%. Some, they need it even more, especially if they want to do leverage strategies. Because today we didn't even talk about the fact that, listen, if you go 50-50 like you proposed, John, you can still access those dollars through leverage to put it into other growth assets. So for some people, they want to get the dollars working in more than one place. It's not the right fit for everyone, right? It's not, everybody doesn't have that same appetite. But if you do, then it makes a ton of sense. So once again, not sabotaging any of the old school principles to make sure you pay yourself first and get money into the markets and get money into assets. But we want to make sure that we're maximizing the use of those liquid or non-volatile dollars that we have trapped inside that corporation.
And that's the secret sauce that we are hoping to share here with you today. And that's the secret sauce we want to share with Mark is that we can be doing better. And there's some structures that you can be putting into place to do better. So we did say that we would also share Mark's, health assessment. I keep saying health. It's his financial health assessment by the end of the call, because we did talk about those for Mark. But let's just run through his financial health report from our end. And if you want to get your report, you can head on over to CanadianWealthSecrets.com/pathways. That will take you to a quick assessment where you can see the different stages, and then that you get a health report or a financial health report on those 4 stages. But specifically, stage 1 for Mark here, stage 1 is designing your vision for freedom, for financial freedom. We gave Mark an A minus. Strengths for Mark for sure is that he's definitely got a clear mindset, a clear long-term mindset. He's been focused on liquidity. He was asking the right questions with us. He's focused on family needs. He's got a clear picture of what he wants to do, and he's got a team around him. He's got an engaged significant other who's also invested in this process. Important part of your designing your vision. Some of the gaps was the uncertainty around his optimal mix and the paying out. So we're hoping to clear that up for him by giving him some ideas around what this could look like down the road for long term. That's what your vision is really about, long term. Okay, stage 2, which is establishing your corporate reservoir. We gave him a B in this area. Strengths for him for sure are he's got retained earnings, which means like his money-making machine is doing its job, and then he's got that fund, like that money that's sitting there. He's also got his holding co and his operating company in place. So he's got some starting points for an optimal wealth reservoir, but he doesn't have that, say, an insurance policy process, the flywheel happening in there just yet. And also he could be doing a better job about thinking about the move we gave him, that secret sauce here today, about thinking about how to strategically plan for the future, which kind of leads into stage 3, which is optimizing your plan. based on the buckets. We gave him a B as well over there. He's got a good balance already. He's making use of the RSPs and he's making use of the tax-free savings account. We gave him some tweaks like we shared here today, but he's also thinking about those in long term. So his gaps were, again, no specific optimization around, say, the RSP or the tax-free savings account. And also he's missing that wealth reservoir in the strategies around that wealth reservoir. So he's missing a little bit of opportunity there. And we've given him those next steps. Last grade here is the fourth stage, which is legacy and estate. We gave him a B because because his vision has included what his estate looks like down the road, mostly from the conversation that we had. We didn't talk about that a lot here today. But he's got a limited kind of model there. And again, if he establishes the corporate reservoir, especially using that high cash value life insurance policy, it bumps him up to an A because that tool automatically gives you a pathway to leave that estate value tax-free to the heirs of the corporation, like the shareholders of the corporation, also family members as well. So overall, we're giving him a B plus. He's got some good moves here and a good foundation to build from, and he's got some great next steps to put into place. And in our eyes, those are not big moves. He's got some small moves now to just put in place to actually capitalize on some of the strategies to turn him from a B to an A for sure, and set himself up for financial freedom down the road, and a great place to live the life he wants, and also for his family to live the life he wants. So this secret sauce episode, we hope you had some big takeaways as we unpacked some important ideas and also some passionate ideas that we fundamentally believe, but also we put into place in our own business. Just as a reminder, the content you heard here today is for informational purposes only. It should not be construed as legal, tax, investment, or financial advice. And Kyle Pierce is a licensed life and accident and sickness insurance agent and the president of corporate wealth management here at Canadian Wealth Secrets.